Hey everybody, back with another dividend analysis, and today we're going to be looking at Lumen Technologies Inc., or LUMN. I wanted to do Lumen because I've been seeing a lot of people talk about them, particularly with the AT&T dividend cut. I've been seeing a lot of people talking about using Lumen to replace them because they have a roughly yield similar to what AT&T's was before the announced cut. So we're going to take a look and see if that's actually a good idea or not. As we can see, the yield is about 7.7%, just under 8%, which for any stock is very good. For telecoms, it's still high for telecoms, though telecoms are often a high dividend industry. If we take a look back at the history, the NASDAQ website doesn't seem to have very much, so we're going to have to go to some outside sources. And as we can see, our last dividend payment was 25 cents a share. But as we go back over time, we can see that the dividend has been slashed significantly. We saw a dividend cut between 2018 and 2019, so well before the shutdown, so that did not affect the dividend. This was prior to that. As well as if we go back a few more years, back to 2012, 2013, we were cut about the same amount, another, in this case, about 18 cents. So we've been losing about 20 cents per share in dividend over the last, 9 years. We've had two 20-cent cuts roughly over that time. That's very concerning. A dividend cut in general is concerning, but a dividend cut of this size, multiple times, is extremely concerning. I'm already very wary about this without looking at anything else. But perhaps they've managed to turn things around, and we could see some dividend increases. So let's go take a look at the company itself. We can see that over the last year they paid out just over $1 billion in dividends. Again, about just under an 8% yield. So let's take a peek at the cash flow. Let's go 4 quarters. We'll go by 4 quarters for our cash flow, and as we can see, their cash flow has actually increased over the last roughly 5 years. Though over the last 10, we have seen a decrease. So this is nice to see. They're managing to increase their cash flow, that they're very able to pay that dividend. If we go by last year's free cash flow, the trailing 12 months, they were only at about a 33% payout ratio, well within our ideal range, so that's some good news. Let's see if there's any more good news when we head over to the income. Let's again go with trailing 12 months. And our net income, we have a very large problem. Actually, looking back over their income, I'm becoming even more wary of this company. Last year, they lost $1 billion, which means they were not able to, there's not actually a ratio. It does not exist because they did not have any income. The previous year they lost money. The 3 years before that, they made about $1.25 billion, but then if we go back even further, they are hemorrhaging money. This company does not make money, generally speaking. That's very concerning. If this was a short-term thing, if I saw, say, these last 8 years here were all positive and these 2 were negative, it could just be, there's a restructuring plan, they're doing something to address the issues, so they're still going to be able to have that cash flow for a couple years. But when I see this, I am just deeply, deeply concerned, and we can see why they had those dividend cuts, because their income had dropped so significantly. Now, over long periods of time, that free cash flow is going to turn negative. If you don't have an income for a company, you are able to maintain positive free cash flow doing a bit of financial gymnastics. There's some things you can do, but that's only going to last a little while. If this continues for another 2, 3, 4 years, you're going to see that free cash flow turn negative, and they're going to either have to take out debt to pay that dividend, or they're going to just eliminate it altogether. Speaking of debt, let's take a peek at their balance sheet. We'll go with the annual balance sheet here, and we'll see that their total current assets are about just over $3 billion. Their total current liabilities, however, are more than twice that. This, again, very alarming. Everything I'm seeing about this company is really starting to scare me. Now, to be fair, telecoms generally operate at a deficit. If we were to look at some other telecoms, say Verizon, for example, they're sitting at $54 billion versus, actually, Verizon doing very well in terms, they are they have more assets than liabilities. So in that case, oh my. But when we go, of course, we go to something like AT&T, we're seeing that they are underwater, but not nearly as much. I want you all to remember that AT&T slashed their dividend having this debt issue, where when we go to Lumen, their debt issue is much, much worse. Underwater by technically over 100%. Now, if we look at their total assets, they are not illiquid. They are, if they were to be liquidated, they would be able to pay off all of their creditors. if everything was valued and sold at 100%. But not being able to cover those short-term liabilities is very concerning. So let's see what else they're doing. Let's see how this debt has gone over time. As we can see here, their debt has actually gotten worse. Back in 2011, they were only 3.5 billion versus 4 billion. Not terrible, not good by any means. They're still underwater, but it's not something that's shocking. But it starts to get worse as we go on. Their assets are not increasing, minus a little blip here in the 2016. Then it starts decreasing again, while their liabilities are constantly going up. Last year they were able to come down a little bit, but still very, very concerning. They are not making money. They are not able to pay off their debts. When a company is not able to pay off their debts, as we saw with the AT&T issue, they will have to do something, and this will include cutting the dividend. Another thing that I want to look at that I usually don't look at when I'm looking at dividend or income investments is their total number of shares outstanding. And as we see from, if I can find it, there we go. Annual. Got to make it annual. They have doubled their shares, so to speak, over the last 5 years. Usually I don't care very much about shares outstanding because most movements aren't big. If a company increases their shares by 5 or 10%, but they've been making a ton of money and they're just trying to capitalize on that, I don't really care. It's not a big deal. I'm not one of those, I have this slice of the pie of the company. I don't believe I actually own the company. I own a share. You can disagree with me on that. That's fine. But this is very alarming. They've doubled the amount of shares they have. That means that they took in a lot of money in equity by selling those shares, but they haven't solved any issues. Their debt hasn't gotten better. They haven't found a way to increase their income because they're still running negative right now. So this is very concerning. I'm fairly certain that this increase and this income right here, this massive loss, there was a write-off here. They probably sold a lot of equity, bought something, realized it was worthless, and then wrote it off. Very, very likely to have occurred. I could be wrong, but I'm not going to do that deep of a dive here. So looking at this company overall, from what we've seen, is there anything to do here? Is there an income play? Is there a dividend play? And the answer is a emphatic no. This is a classic example of a dividend trap. They have the dividend yield that they do. They're keeping it at 25 cents, which is about 8%, to lure in investors to try and get money into the company because they can't make money running their business. That dividend yield, that dividend of 25 cents, this is going to be cut or eliminated soon. I'm 99.9% sure that this 25 cents will probably get cut down to 12.5 cents, or be eliminated altogether. They're not going to have a way to pay it going forward if their income remains negative. They can only do financial gymnastics for so long to keep that cash flow positive. That cash flow will start to decrease, and so this dividend will as well have to decrease. Is there any play to make here? Again, from the income or dividend side, no, there's nothing. However, if the company comes out with a plan to turn themselves around, say a la AT&T, but it's actually a good plan, not AT&T's terrible plan, you might have a play here just from a value perspective, but that plan has to come out and it has to play out. This dividend will not increase in the next decade, probably not in the next 2 decades. This will have to be a long-term plan to reshape and return the company in a direction that's going to make them money. If someone were to offer me this company as a whole, for example, give me every share, I would decline unless I could sell it immediately to try and make a profit that way. There's just no money to be made here long term. The only thing I would even consider doing with this is day trading, and even then I would be very, very skeptic because news could come out driving the price down on that dividend cut. They could announce that at a quarterly report or something, and you could see the price nosedive. So if you're looking at Lumen, I would stay away. There are better plays out there. If you're looking for a telecom dividend, you have something like Verizon. If you're looking for a 7% yield, there are other industries to look at. You don't have to be stuck here. Don't get suckered into a dividend trap. This is something, as a dividend investor, you should know from day one. Know what a dividend trap is, know how to avoid it. If you're looking at this company and you think, oh, this is a good dividend play, you really need to rethink the way you're evaluating dividends, because you are the patsy that these companies are looking for. You're the kind of person that they make money off of, or that they take money from to keep their business going while it's dying. So I hope that helps, and thank you for watching.